Today is the 12th of July 2021. My name is David Hickson, and in today's market update I'm going to be speaking about the S&P 500 again. I'm also going to take a quick look at some other markets, some markets in Europe. Although I don't have a huge amount to add to what I said in last week's market update and the week before, some interesting things did happen last week, and there were many questions about what happened and how that changed the analysis. And so I think it's important to focus on those questions and answer those questions. I believe there's more benefit to be gained from focusing on these kinds of details than to be jumping around from one instrument to another. I know that many of you have requested other instruments that I look at, and I apologize for focusing again on the S&P 500, but I do hope that the video will include some useful information for you. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. So, as I've already mentioned, I don't have a huge amount to add in terms of the analysis that we've been tracking over many months in the S&P 500. In my opinion, we are still expecting the 18-month cycle trough to occur. For some time now, we've been looking forward to it occurring late in July, and of course we are approaching the point at which it will be late in July, and yet the markets, or at least the US markets, have stubbornly been refusing to turn down into this 18-month cycle trough. I spoke about time translation in last week's video, and if you haven't seen it, I would encourage you to go back and take a look at that video, because it's a very important concept. The basic idea is that when we have a bullish underlying trend, which means that the longer cycles are bullish and pushing upwards, then we will tend to experience very late peaks. The more bullish the underlying trend is, the later the peak will be. And it doesn't really take an expert to realize that we have a bullish underlying trend, because it is fairly clear that the markets have been moving upwards. In other words, they have been experiencing a lot of bullish pressure ever since March of 2020. And so we are expecting a late peak, or I should say we're not surprised by the fact that the peak is occurring late, but it really seems to be occurring very late. So what is happening? I received several emails and comments on the YouTube video asking whether the price action of last week changes everything. In my opinion, it doesn't, but I would like to go into a little bit of detail here in terms of what did happen last week, and take a look at some other markets, because I think it's very important to keep an open mind as to what might be happening. First of all, let's take a look at the other two analyses that I have looked at in the past two market updates, I believe. The first is this analysis here, which is the default analysis that Sentient Trader is performing. In other words, I have not influenced this analysis at all. And as mentioned in previous market update videos, you can see that the trough that we are still expecting in late July is a trough of only 20-week magnitude, which might explain why we are not yet seeing quite such a big move down into the trough, because it's a lower magnitude trough. And according to this analysis, the 18-month cycle trough is expected towards the end of this year, or perhaps in early 2020. And so it is possible that the default analysis is going to turn out to be correct. It often is. However, as I explained in last week's market update, I believe, or perhaps it was the week before, I forget now, but there are various reasons why I do not favor this analysis. I think that the analysis I've been tracking is a better analysis. I'm not going to repeat those reasons. You can go back and take a look at those videos. The point is that even if the default analysis is the correct one, we are still expecting price to come down into a trough of 20 weeks. Now, 20 weeks is a fairly long period of time, and so you would expect a little bit of price movement down into the 20-week cycle trough. And so whether it is an 18-month cycle trough or a 20-week cycle trough, we would nevertheless expect a peak to form, and we would expect price to start moving downwards. The third option that I presented in last week's market update video was the possibility that the 18-month cycle trough has indeed formed in this market, and that it occurred early. Now, it wouldn't be very surprising to see an 18-month cycle trough occur early, because of the very strong bullish underlying trend, which causes peaks to occur late and troughs to occur early. Nevertheless, in last week's market update video, I discussed various reasons why I don't favor this analysis, and this is still not my preferred analysis. However, in the last few minutes of last week's market update video, I spoke about one way in which we could bolster our confidence in terms of one analysis or the other. And that had to do with what happened when price came down and touched or interacted with the 20-day FLD. So let's switch back to my preferred analysis first and see what happened. Here I have zoomed in on the most recent 80-day cycle, and I've spoken about the interactions between price and this 20-day FLD in previous market update videos, and you can see that the sequence of interactions was in fact tracking very normally. It's a fairly regular sequence of interactions. Take a look at the previous market update videos that explain them. I'm not going to go through them all again. But in last week's market update video, I pointed out that, let me just quickly label these interactions. There's our A and B and C and D and E interactions. I pointed out that the next interaction that we expect is an F category interaction. And so we were expecting, according to this analysis, for price to come down and cross below the 20-day FLD. As you can see, it in fact did exactly the opposite. It came down to the FLD, gave a bit of a bounce up, and I should say that whenever price encounters an FLD, even when we are expecting it to cross down below the FLD, we will often see a bit of a reaction from price. Even when we're expecting price to cross an FLD, particularly when you're watching on an intraday level, you will often see a bit of reaction from price. It's an extraordinary thing, and it demonstrates time and again the power of the FLD line. It's something I've spoken about in previous videos, and no doubt I will speak about it many more times, but it's a very interesting thing that we often observe. So let me just erase that circle around that interaction and point out how price came down on Thursday of last week, touched the FLD, and then immediately bounced back up again. At the end of trading on Thursday, that looked as if though it might still turn into a good and clear F category interaction. However, as I pointed out in last week's market update video, and this is the important point, if the alternate analysis was correct, and we did have an 18-month cycle trough here in the middle of June, then we would expect the 20-day FLD to provide support at that point. So let's switch to that analysis and take a look at what happened there. I discussed the sequence of interactions that occurred in May and June in last week's video, and I pointed out many of the discrepancies that occurred in that sequence of interactions, which was one of the reasons why I don't favor this analysis. I still don't favor this analysis, even though we in fact saw what looked like a perfect B category support provided by the 20-day FLD, which was provided at exactly the time that the 20-day cycle trough is expected to form according to this analysis. So what is happening here? Well, here is the 80-day cycle trough, or at least the 18-month cycle trough, but of course we track the sequence of interactions with the 20-day FLD between one 80-day cycle trough, there it is in the stack of diamonds, to the next 80-day cycle trough. And here is our A category interaction, which achieved its target. And I mentioned in previous market update videos that that target was at a level of 43.45, I believe, and so it achieved that target. It ever so slightly exceeded it, but not by very much. Then it came down and it found support at the level of the 20-day FLD. I mentioned in last week's market update video that if that was what happened, then that would increase our confidence in this analysis. So where do we stand? Well, that is exactly what happened. And so the chances that this is the correct analysis and that the 18-month cycle trough has occurred are slightly increased because of the fact that price found support at the level of the 20-day FLD. However, it isn't as simple as that. The fact that our confidence is increased does not mean that I'm now 100% certain that the 18-month cycle trough has formed. In fact, I still do not prefer this analysis. Some of you might be throwing up your hands in disgust because you are seeking complete certainty. I must point out that in my experience, achieving complete certainty in an analysis is a fairly rare thing. There are times when the cycles are very clear and your confidence is very high. Absolute certainty is fairly rare. At the moment, we do not have much clarity, and even though the chances that this analysis is correct have been increased by this interaction, I would like to spend the rest of today's video by pointing out why I still do not think that the 18-month cycle trough has formed. Hurst cycles is a very rich and complex approach to understanding the price action of financial markets. As I've mentioned, achieving absolute certainty is a difficult thing to do. However, and this is an important idea to hold on to, even when we have uncertainty, we are able to make clear trading decisions. That's a point I'm going to come back to just a little later. But let's take a look at some of the other information that we have at our fingertips in terms of clarifying exactly what is happening here. Let's stay with this analysis that has the 18-month cycle trough as having formed in the middle of July and take a look at the composite model line. The composite model line, as I've mentioned in many previous market update videos, is simply a recomposing of all of the information that has been found as a result of the cycle analysis that has been performed on the chart. And so it is actually simply another way of visualizing the analysis that we see on the chart. So one way of visualizing it is, of course, through these Hurst notation diamonds, and another way of visualizing the results of the analysis is through the composite model line, which simply takes the results of that analysis, extracts all the information, recomposes it, and produces this line, which tells us that if the only thing affecting this market over the period of time displayed on the chart were the cycles that we have found in the analysis, then that orange line is what would have happened. Of course, cycles are not the only thing that influence markets. Markets are also very much swayed by many other things, news events, general economic mood, social mood perhaps. But how can we use the composite model line to gain some insight into what this analysis is telling us? Well, I think you can see fairly clearly that all the way up until about mid-March, the composite model line described the price action fairly well. It's not perfect, of course. Price didn't come up quite as high as was expected here in June, according to the analysis information, and we had a little bit of a divergence between what was expected and what happened in price over here in September of last year. But I would like to draw your attention to this period of time in terms of what happened after March of this year. The composite model line shows us that according to the cycle analysis at the foot of the chart, the cycles were influencing price to move downwards. What happened? Well, exactly the opposite. Price moved upwards. That is an indication that this cycle analysis does not fit the price action very well. And it is yet another reason why I do not support the idea that the 18-month cycle trough has formed, despite the fact that the 20-day cycle FLD did provide support for price last week. Here is the composite model line for my preferred analysis. And here you can see that in the past the composite model line matches price action a little bit better actually than it did in the other analysis. And there is not the same divergence from March all the way up to the current time between price and the composite model line. We have seen that divergence occur over just the past few weeks. So what does that divergence mean? Does it mean that the analysis has broken down just over the past few weeks? In my opinion and my experience, that is not what it means. What it does mean is that there is possibly something else happening here, which is perhaps some external influence. There are lots of other things that are happening that keep pushing the US markets upwards. And so on that note, let's take a look at some other markets and see what they are doing. Let's go across the oceans and take a look at the FTSE 100 from London. Here you can see something interesting. We have a composite model line that matches the price action fairly well. You can see there have been some discrepancies in terms of the amount of bullishness that was expressed in the cycle analysis, which simply isn't there in the price action. And you can see the same discrepancy between the composite model line and price action. However, the price action has not been so consistently bullish over the recent period of time. And we have seen more of a sort of a flat line price action as price comes into the 18-month cycle trough. It certainly looks as if though the 18-month cycle trough still lies ahead in the FTSE 100. Here we have the DAX from Germany. Again, we can see a fairly accurate description of the structure of the market in terms of the composite model line is moving up when the price is moving up, and the composite model line is moving down when price is moving down. That's what I mean by the structure of the market matching between the two. We have a little bit of discrepancy recently, but not nearly as much as we have seen in the US markets. And again, the 18-month cycle trough seems to lie ahead in the DAX. If we zoom in and take a look at the DAX in more detail, we can consider the interaction between price and the FLD, and we can trace our interactions. The interactions have not been very clear, but you can see that price last week got into a bit of a tangle with the 20-day FLD and bounced down below it, above it, below it, and above it, leaving behind what is probably a 20-day cycle trough. It is possible, of course, that in these European markets, that is going to turn out to be our 18-month cycle trough. We need to be standing by for that possibility. However, it is, in my opinion, unlikely. Finally, if we have a look at the European stock index, you can see a very similar picture. Here you can see that price has actually been tracking the composite model line fairly accurately over the past few months, and that the 18-month cycle trough is expected fairly soon and not necessarily at a much lower level. So let's go back to the S&P 500 and ask ourselves what happened last week, where we saw price come down to the 20-day cycle FLD and find support. That was not what we expected. Of course, we would expect a little bit of a reaction at the 20-day FLD, but to find support and immediately jump up to new highs is not typical behavior. And this is where I would like to speak about volume. I'm able to plot the volume for each trading bar below the price action in Sentient Trader, and because of the way that I have this set up, the blue bars are bearish days, in other words, the closes below the open, and the green bars are bullish days, the closes above the open. An interesting thing happened last week. On Thursday, when price came down and touched the 20-day FLD, we had a high volume day. In fact, that was the highest volume that we have seen since about the middle of May. And on Friday, when price broke back up again to new highs, we had a slightly lower volume. I am by no means a volume analysis expert. I had many interactions with a wonderful analyst called David Weiss, who has a website called Weiss on Wyckoff. I should say he had a website because very sadly he passed away in December of 2020. I had several very fruitful interactions with him discussing the concept of volume and Wyckoff's approaches in combination with Hurst cycles. He was actually also an enthusiastic Hurst cycles analyst. And volume is a very useful tool that you can use to enhance your understanding of what is happening. In particular, when price comes down and forms an important trough, we would expect the bullish volume as price moves out of that trough to be greater than the bearish volume. Now, we're not working with a lot of data here. We're only looking at 2 days, Thursday and Friday, so this is by no means a final piece of evidence that cinches the deal, but it is something that is useful to watch. Let me show you very quickly what I mean. If we take a look at the important troughs that have been identified in this analysis, the 54-month cycle trough in March of last year and the 40-week cycle trough in October of last year, if we look at the volume pattern, you will see that generally as price bounces out of these troughs, we see higher bullish volume. That's not unusual. You can see the higher bullish volume. It's perhaps a little difficult to see down there with those green bars, but here at the 40-week cycle trough you can definitely see the patch of green bars with the higher volume occurring as price bounced out of the 40-week cycle trough. Even here where we had an 80-day cycle trough, you can see the burst of bullish volume that occurred around about that time. The 20-week cycle trough was not quite as clear. We had some bearish volume as price came down into the trough, of course. There are some bullish bars in there, but it was not nearly as clear at that point. The point that I wish to make is that the price action last week is not showing a clear bullish surge out of last week's trough. Of course, it is early days. As I've mentioned, I'm only looking at a very small piece of data here, but even so, I think it does provide us with a little bit of a caution if we take a look at the 20-day cycle trough as phased in this particular analysis. You can see we had, of course, some bearish volume as price came down into the 20-day cycle trough, and then almost as much bullish volume as it bounced out again. And so for all of those reasons, I still believe that the 18-month cycle trough lies ahead of us. I think it is quite possible that this 20-day cycle trough that has been found in this analysis in early July should be more correctly positioned under last week's trough, with one more move down into this 18-month cycle trough. However, there is of course still some uncertainty in terms of our consideration of this analysis. So how do we make clear trading decisions? I have two important points to make here. The first is that when we have analysis uncertainty, as we had last week in terms of not being absolutely certain whether price would plunge down below the FLD in an F category interaction, which was what was expected, or whether it would prove to be a B category interaction if the 18-month cycle trough had formed, less likely but possible. Under those circumstances, the best trade is no trade at all. I think that's a really important point to make. The second point that I would like to make is that if the 18-month cycle trough does still lie ahead of us, then we do still expect price to drop down below the 20-day cycle FLD on its way down into the 18-month cycle trough, in which case that will prove to be the F category interaction. What will this touching of the 20-day cycle FLD from last week prove to be if that is the case? It will just prove to be a slight anomaly, something that in fact we often see in the sequence of price and FLD interactions. But now if price does come back down again, and we still have these two possible scenarios in our minds. One is that this was a B category interaction where price touched the FLD, and the other is that it is an F category interaction that has not yet occurred. What are our options then? Our options are that it is either an F category interaction occurring later than expected, or it is the next interaction, which would of course be the D category interaction, because the C category interaction was the price action that we saw on Friday, where price moved away from the 20-day cycle FLD. Under those circumstances, both are possible trading opportunities, either a short F category trade or a short D category trade. However, the markets come back and provide us with yet another challenge, and that is that if price fails to go much higher, and I'm not saying it's definitely going to fail to go much higher, but if it does, then we might find that as price comes down and crosses below the 20-day FLD, we generate a target that is so shallow, if you like, that it's again a trade not worth taking. I do hope that you found this market update interesting. If you have any questions, please put them in the comments below the video. We look forward to hearing from you.